Hi, in this video I'm going to show you what stochastics are and how you might want to use them. Now, they're a common indicator that are used and misused quite a lot in these modern days, so I thought I'd go through them in some detail. Now, I should say this is one of possibly two videos. The second video I'm going to do is look at taking the stochastics and taking it a step further and giving you a very simple stochastic strategy. This is about how to use them, what they show you. So, firstly, what are they? Well, stochastics are an oscillating indicator. In other words, they're bound between two levels, and the price will rise and fall between those two levels, or in percentage terms in the case of the stochastics. George Lane actually developed them back in the late 50s. I haven't actually seen a date when he actually put on there. I looked through many a source, and 1950s is the best I can do. He was actually looking for something which showed him overbought and oversold signals in stocks at the time, and this method of calculation seemed to do the trick for him. Now, the data is shown bound between 0 and 100%, as I've mentioned, or 100. Now, the calculation is basically looking at the current close minus the lowest low divided by the highest low divided by the lowest low. So there's the basic calculation. Great thing is you don't need to do any of the calculations, it's all done for you. As you'll see, it's done as percent K, because it's effectively as a percentage. So that's the percent K, the stochastic itself. You've then got a percentage D, which is a simple moving average, and I put 3 day here. It's actually a 3-period simple moving average, depending on what time frame you're on. Percentage of the percent case, it smooths it effectively. Okay, so they're just the numbers. Standard. Now, the standard period, when I'm talking about periods here, is a standard period of 14. Now, there's two main calculations and two different sort of stochastics that you might come across. Well, actually, there's 3, but the majority of them are either fast or slow. The fast one is with the percentage K, or the standard deviator, the stochastic left as standard, or it's referred to as 1 on the indicator on things like TradingView. And then there's the slow version. This what they've done here is smoothed out the stochastic with a 3-period moving average. So effectively, it's what the percent D is in a normal one. Anyway, and then the percent D again is then a 3-period simple moving average of the slower percent K. It's a lot simpler when we look at it on charts. Data shown bound, as I've already said, between 0 and 100. Now, the basis is that results over 100 are shown at an overbought market, and results below 20 as an oversold market. One thing it shows really is the speed and momentum of price. Now, you could see that on a chart, and the one thing I would always say with any indicator is most of what the indicator shows you is right in front of your eyes. However, the more I do back testing and look at sort of giving set parameters for people to trade with, I'm finding that actually perhaps adopting an indicator to give them the right, if it does this, hits this, then you do whatever. It gives you a more rule based. It makes things a little easier to make rule based. So one of the things that Lane was doing was looking at the theory that momentum slows before price changes. Where we see this, we see consolidation in price. So occasionally it consolidates and continues, but whatever, the momentum itself is slowing before changes, even if it is the continuation. Divergences are used then to identify possible reversals, and this is the first way he used it. So he's really looking for divergences within the stochastic itself, the indicator, the percent K. But then he went on to look at the indicator and identify just long and short setups as the oversold and overbought areas, so i.e. minus 20 and plus 80. So best thing to do before we look at what you must really know is have a look at what they look like. and I've immediately gone to the wrong chart. There we go. Let's get the right chart up. So here's the stochastic on the bottom here, and here's price. Now, the stochastic settings themselves. If you're using TradingView, I've got this set on the fast setting at the moment. So there's the stochastic period is 14 periods. So if I'm looking, I've got days on here at the moment, it's 14 days. It's got a smoothing effect of 1, so it doesn't adjust it at all. It's fast. And the other second line, the %D line, the moving average line there, is set on 3. Okay, and it's adjusted on this particular case to whatever time the chart's showing as. So that's that. Now you can adjust things, put up a band, take the upper bands away and things like this, but there's no need to really do too much to this. So that's the fast movement. What you can see, the stochastic is in blue. You can see it's quite choppy at times, or you can adjust it. It doesn't matter what you use as long as you stay consistent with it. And there's the period of 3, which is much smoother. Now, some traders would run and prefer this, and personally, I tilt towards this area. If you're looking for divergences, though, within the %K or the stochastic itself, you might find that the fast one is better because it gives just that little bit more. Let's just bring this down to, it just makes it look like it's going to give you a divergence now and again. There aren't a great deal when I'm just looking through this very briefly, and I can't see much. I can see some divergence which never kicked into play. Okay, there's a divergence between this high here and the actual high in price there. So there's a divergence there, and that's kicked off and run. So how might you use them? Well, as I've already mentioned, they show overbought and oversold signals, and all of a sudden you're going to be looking at this chart and thinking, "Truth, it's the holy grail. Look, that was overbought at that up in those levels there, and now then it went to oversold." Yep, sure, but it stayed then oversold for a long time. So if you'd just taken the decision that you were going to sell and then buy, well, you'd have missed out on all of this. And if you had actually been buying at these sort of levels down here to take advantage, well, of course, you'd have probably been stopped out. So there are risks in terms of what you're doing with this, and it really does need to be sat around a proper you've got to tie some rules around your strategy and understand what you're trying to achieve. So as I say, divergences, it will show up. Overbought and oversold signals, it can also show up. One thing I would say is, depending on how you're building your strategy, you can look at actually where the signal line crosses back below the 80. For some people, this would make a decent sell point with a closing point on the 20 level there. Now, of course, you will have missed out on the rest of this. You could wait until so you get a sell point here. You can wait until you get a buyback, well, a buy point, where the smoothing line, the moving average, hasn't gone below the 20 until down here somewhere. So you'd be waiting for all the way down to here if you're using that basis, slightly different basis. So the moving average line is above up here. So when I'm looking to potentially sell it, it would be up at this point here, crossing the line. You'd wait until bar closes. Now, this is a daily chart. It looks absolutely wonderful. Wish I'd spotted this one, but there's plenty of other ways of spotting this one. Anyway, then the exit point, well, wait for it to come below. Actually, it came below there, so you might have been out even earlier than down here. You've got to be careful you don't only see what you want to see. The thing is, when you go back and backtest something like this and look for these highs and lows, you only see the highs and lows that actually work. When this is showing a low here and it's continued to run, most people ignore that because it didn't work. So as I say, you've got to be looking here. I mean, this is perfect in terms of its overbought area here, and there are some rules which you could tie around, which I'll discuss more in a separate video. So for now, I would have a look at it if I were you. If you want to use it, not only should you look at indicators as something to get you in the trade, you might be wanting to get them out, use them to get out of a trade. For example, if you were long on this area here, it might not necessarily give you a complete exit, but it might tell you to actually move your stops up You can use the indicator. It's showing weakness of the price action once it starts rolling over here, and once it's broken, well, on this bar here you might have been exiting, or you could look to exit on the close. It's an example. If it makes it simpler for you, it's as I say, a good example. Now I'm using this tool then not as necessary an entry trade then, or an entry tool or signal. I'm looking at it to give me exit signals. Now of course it's not going to give you such a good exit signal all the time, so there's other methods you can use, and it might be you use it as an entry signal and look for something else for your exit. But I'll leave that up to you, because you could sit in something for quite some time. One thing I would say is look up the time frames, look for what the weeklies are doing as well, and where it is relative to its weekly movements. And it might be that you can actually, well, you certainly can start building things together and look for the signal that might be coming up on the bigger time frame, and just wait for the shorter time frame for taking the trade. So some ideas there. Now I haven't quite finished. Let me just pull my slides back up. So what you must know, okay, the overbought and oversold signals can remain in those zones for a long time. As I've already mentioned, I pointed those out. Very important. You should always refer to back to the upper time frames. I've just pointed that out. And one thing that everyone comes to forget at times, price is king, and this is what puts me off indicators a lot, is that people forget about what the price action is actually doing. Reading price action can't be you can't beat reading price action itself. It should be the key skill that you pick up as a trader, and then you can use these indicators for entries, exits, etc., and build up really solid strategies. Okay, we'll leave it there. Now, if you like this video and you want other videos, give me a thumbs up if you like it. Thank you very much, much appreciated. If you want, make sure you don't miss the video when I'm going to put the simple strategy on there. Might give you a few back testing results on there, which you could go away and improve on. So I'll pop those on there as well, most likely. And so I'll share something that's obviously working, or maybe not working quite so well at the moment, but you might want to go away and adjust it. So that'll be there. So just sign yourself up, subscribe, and click the bell or whatever it is, and it will give you a signal when the next email comes, video comes. Okay, take care. Bye for now.